Since 2008, unconventional oil production, also known as tight oil or shale oil, has been the only real driver of U.S. supply growth. The unprecedented ramp up in this supply ushered in the era of cheap oil and destabilized the global market, as I mentioned before.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Christine Guerrero joins us to talk about the energy markets. Christine is a seasoned engineer with extensive experience in the oil and gas industry. She's worked with major energy producers, including Chevron, where she specialized in deepwater drilling operations. Christine is recognized for her in-depth analysis of integrated oil exploration and production companies, and generously shares her knowledge through channels like ours. Christine, thank you for coming on the show.
Hi, Steve, and thanks for having me on.
Yes, the pleasure's all on this side of the table. You have a detailed presentation on the Permian Basin. Let's start off and just give us kind of how you got into the sector. Tell us your story and how that led to where you are today.
Yeah, so basically, if you want to go all the way back, 1996, I was entering college, and the petroleum engineering department at the University of Tulsa said, if you'll study petroleum engineering, we'll pay for Hacker University, and so I've been in petroleum engineering ever since. Came out of school during a downturn, started working in the Gulf of Mexico for Schlumberger. A few years later, I got hired away from Schlumberger by Precision Drilling, which is a Canadian-based drilling contractor who was developing logging while drilling tools. So then I worked for them for a few years on the LWD side, which is logging while drilling, and also the rotary steerable side. Directional drilling is kind of what it has enabled the Permian Basin to be producing the levels that it is. So it helps to have a lot of directional drilling acumen there. And ultimately ended up at Chevron, where I worked in the rock mechanics group, basically doing drilling optimization consulting for all of their assets worldwide. They've ended up paying for my MBA, cross-trained me into strategic planning and decision analysis. So then I was looking, at pipelines and new country entry and, whether or not that, like what assets to put into the portfolio or groom from the portfolio in order to, maximize the company's value. Ended up over at Hess Next, also working as a strategic advisor in their global exploration and planning group. But then during the downturn in 2015, I was laid off along with almost everybody else in the exploration group, and ever since then I have been a private investor. Got really focused on oil and gas during the COVID crash for obvious reasons. I knew that if I put all my money in oil and gas, it was going to go one or two ways. Either COVID was the zombie apocalypse and most of us was going to die, and it wouldn't matter if I lost all my money because I'd either be dead or almost everybody else would be. Or, COVID wasn't going to be the zombie apocalypse and oil would rally and we'd be basically in the world that we are today. So ever since then, I have been online, talking about oil and gas and why it's a strategic asset, why it's sustainable, why we need to invest in it, talking about different companies that I liked and didn't like, slowly got invited on a number of different podcasts, similar to how you invited me on this one. And basically one of the podcasts, apparently it had a very large following. Somebody from New York, heard me talk. And then next thing you know, reached out to me and wanted to know if I should, if I wanted to be a strategic advisor for an energy fund. So that's currently what I'm doing, on the side is I'm advising, a New York fund on, basically the macro for oil and gas and, different things that various companies have doing. And when we see, the right opportunity, we add them or subtract them, from the portfolio. But, for the last 2 years, it has been very hard to be invested in this sector because there is a lot of noise and a lot of stuff going on. Oil dipping into the 60s for 2 years straight now. It's not good for the industry. But you're going to hear from my presentation why I believe that it's an investable opportunity going forward. So
Okay. That's full circle right there. So you started studying this back in 1996.
Yeah, I'm 47 years old, so I've got some gray hairs, and I've been all around the world, either consulting on oil and gas opportunities, working in those fields directly, or even now, as a strategic advisor. I mean, I'm listening to 50, 60 different earnings calls every quarter, tracking what companies are doing in the oil and gas sector, whether it be service companies, drilling rigs, operators, seismic companies, all those, basically collecting all these data points to help me groom my macro and micro thesis.
Okay. Yeah. So you basically started as a kid and then worked for Schlumberger, engineering for Chevron, and then now you're studying these companies, listening to all the quarterly calls and investing in them. That's pretty cool. Okay. Now your presentation is on specifically the Permian Basin, correct?
Well, it's got a focused component in it on the Permian Basin. I mean, it's macro. It's very regional because I'm going to talk about what regions I believe are going to be supplying or basically adding in added barrels next year. So I think it was either Goldman or J.P. Morgan. They recently came out, stating that they believe that non-OPEC countries are going to add, 1.6 million barrels or somewhere around that number next year. I do not believe in that thesis. I believe that non-OPEC barrels is going to be less than 1 million barrel per day growth. And so we're going to talk about what countries I believe that's going to come from. And then I'm going to talk about why I feel like the Permian Basin is plateauing here, and some fundamental challenges that I think that the Permian Basin is going to struggle with in the years to come that might keep them from ever achieving the production expectations that many people have baked in. So
Okay. All right. I'm excited. Let's I got my notepad ready here. Let's get right into it.
all right. And I've already shared the screen, or can you see the presentation?
No, not yet. You got to hit the little share down below and then click on your presentation.
I told you when it comes to technical, that's when I start showing my age, So this is my 2025 oil and gas outlook. Like I said, I'm a strategic advisor, and if anyone following this presentation, if you want to reach out to me for further consultation or whatever, you can find me at Christine Guerrero at octane.nyc. Just the high level disclaimer, what you're about to hear. I mean, this isn't investment advice. It's not an offering or solicitation to buy or sell anything. I've just given my background. All the observations presented are my own. They're not necessarily the fund's views. And also, I am an engineer, an engineer with an MBA. I'm not a financial advisor. I'm not a portfolio manager, nor do I hold, any licenses to that effect. So, if you're making major financial decisions, you might want to reach out to someone who is a CFA.
Okay, now our lawyers are satisfied.
Exactly. Well, and then it also obtains lawyers, so I don't want to get them into trouble either. So I'm going to kind of start, with this global energy view long term, and then I'm going to channel in, into near term and then regional focused.
Okay.
So going forward, the one thing everyone needs to recognize is that there is no energy transition. There is only an energy expansion, and the world needs all of the above energy sources now and in the decades to come. If we compare CapEx spent since 2015, nearly 15 trillion US dollars has been spent on alternatives, and they have grown by about 8.5 thousand terawatt hours of energy and supply nearly 8% of global energy nowadays. Meanwhile, less than a third, less than 5 trillion US dollars has been spent on global oil and gas supplied, which grew by 5.5 thousand terawatt hours and is 55% of global energy supply. Simply stated, alternatives are easily twice as expensive to grow per terawatt hour as oil and gas. And that is ignoring all the added value that comes from petrochemicals that offshoot from oil and gas. Renewables are growing, and they will continue to grow. They could be the dominant energy source by 2050, 25 years from now. But oil and gas requirements are also going to grow. So now let's talk global oil demand. For the past 100 years, oil has grown at approximately 1 million barrels per day per year. This is a pretty easy to follow trend for 100 years. COVID created a short-term demand inflection as governments coordinated to lock down their populations for the first time in history. But now that the world has returned to normal, we are once again demanding and consuming higher volumes of oil year over year. Under current laws, oil consumption would increase at least through 2050. Even if road fuels have already or will soon peak, future oil demand growth can be almost entirely linked to petrochemical feedstocks. Petrochemicals are essential to the chemical industry, the economy, and society because of the ever-expanding use of this material. They are the building blocks of plastics, thermoplastics, solvents, lubricants, detergents, plexiglass, synthetic rubber, synthetic adhesive, herbicides, fertilizers, synthetic fibers, insecticides, cosmetics, Teflon, nylon, propane, etc. EVs, wind farms, and solar panels would not exist if it weren't from the petrochemicals they are made from. The trend of slowing popularity in EVs and lessening the commitment to environmental targets might lead to an even longer transition or slowing down of oil demand beyond 2050. Again, 25 years from now. This is primarily in providing improved living conditions for large population developing nations. This regional chart shows how Asian nations have been the driving force of demand over the past 25 years and will continue to be driving forces in demand in the decades to come. Over the past 2 decades, there was a modest decrease in consumption in high-income countries. But in upper middle-income countries, oil consumption increased by 92%, and in lower middle-income countries, it increased by 74%. The emperor has no clothes when it comes to claims of peak oil demand globally. Here's a fun fact. If the average Indian had the same energy access as the average Indonesian, India would consume 2.7 million barrels per day more oil and still have less than half the energy consumption of the average Chinese and 1/10 the consumption of the average U.S. citizen. Large population countries in the global south, like Brazil, India, Pakistan, Indonesia, China, Nigeria, etc., are working to elevate their economies. And as they do, they will consume more oil and gas, more energy, more petrochemicals.
Well,
And it's hard to argue with the numbers.
yeah.
So now let's zoom in and discuss oil demand for 2025, because that's really what matters to most investors. OPEC, the IEA, and the EIA are all predicting that oil demand increases next year by 1.1 to 1.5 million barrels of oil per day. Funny how we keep trending up along this 100-year oil growth projection. In graphical form, notice how the demand has basically moved back to this pre-COVID trend line. So now, the elephant in the room, the Trump factor. In the 5th century, there was a rabble-rousing Athenian politician named Herbolus. Herbolus is known in history as a demagogue, a leader who makes use of popular prejudices and false claims and promises in order to gain power. In my mind, Trump pretty much embodies these same antics. Fundamental facts such as price, technology, and access term oil production, not which political party controls the U.S. White House. I mean, the trends are basically clear. Ronald Reagan up and then down, Senior, down, Clinton down, Bush down, Barack Obama, man, he was really good for U.S. oil and gas. Trump, okay, all things considered, he was up, and then Biden was also really good as Trump, as good as Biden or Obama even, with oil production. But it all comes back to price, profitability, not who's in the White House. While Trump says that he will open up leasing and drilling in federal land, it's not obvious that the government is currently doing anything to hinder any federal production. About 70% of U.S. crude is produced on privately held land, not publicly held land. For example, the Permian Basin produces over 6 million barrels per day, with over 2/3 coming from Texas. There's virtually no federally owned land in this part of the Lone Star State, so easier leasing would not juice any output whatsoever. In New Mexico, where production has grown rapidly, drilling on federal land has already risen sharply under the last two administrations, which has been pointed out by Energy Data Tracker Interap. Man, this does not like that slide. Okay.
There we go.
In my opinion, drill baby drill is nothing more than a campaign slogan that hurts investment sentiment with bold claims of added U.S. supply and lower oil prices. It's good to remember that $70 per barrel today is equivalent to $55 per barrel in 2019. At that oil price, the industry was slowly going bankrupt. Too many pundits treat oil and gas as inflation agnostic, but the capital required to purchase labor and materials to activate wells and maintain supply most certainly is not. The threat of producers embracing drill baby drill mentality is bearish, but it's not grounded, in fundamentals. So what about tariffs? Charging 25% levies on oil and gas from the U.S.'s top two trading partners would spike gasoline prices in the Midwest, raise electricity costs along both U.S. coast, and hammer profitability for American refiners. Nearly 97% of Canadian crude exports flow to U.S. refineries. U.S. refineries can't even handle our own large quantities of light oil produced in the Permian Basin. They were built prior to the shale boom to process heavier crudes that can be diluted with some of our light crude, but not much of it. The rest of it is shipped to newer refineries in Asia that can handle the crude. For decades, the U.S. has been the refiner of choice for Canadian crudes that can be delivered to us cheaply via pipelines. So if Trump moved ahead with this tariff scheme, it would be interesting to see if the Canadian producer or the U.S. consumer would take the brunt of it. A threat of tariffs is bearish. Under Trump's first term, exports of oil from Iran, Venezuela, and Russia was down 4 million barrels per day. 3 million barrels per day of sanctioned oil came back into the market under Biden as he wasn't enforcing these sanctions. If Trump turns around and now enforces these sanctions, it is very bullish for oil, as it could allow for the majority of OPEC spare capacity to immediately be re-entered into the market. Recently, there has been a slowdown of Iranian oil exports, confirmed beyond any reasonable doubt. There's clearly a change in behavior by the Chinese and Indian buyers. They seem to be reducing sanctioned oil purchases by a full 1 million barrels per day for the first time in over 2 years. This will affect the European and U.S. East Coast refined product market, as I doubt China private or Indian refiners will be allowed to draw down their own domestic crude inventories to supply foreigners, especially in the context of a trade war. The open secret is that Indian diesel and Chinese petrochemicals are largely made from oil from sanctioned countries. Reduce one to a trickle and the others will follow. So now let's talk about key oil suppliers for growth. These are the top 5 oil-producing countries today. The U.S., Saudi Arabia, Russia, Canada, and Iraq. You can see the dramatic increase in U.S. oil production from 2000 to 2018. This increase was the shale boom. And here's another even busier chart. The U.S. is in royal blue. Russia is in red. Saudi Arabia is in gray. Canada is in green. Iraq is in navy blue. Notice the dramatic increase again from U.S. production. You can see that the Canadians have also been increasing their production. Russia and Saudi Arabia over the last 10 years, relatively flat. And Iraq is in this navy blue, and you can see how they were adding production. So one thing that I always like to point out to the shale boom, it has been incredibly market disruptive.
Yeah.
So from the shale boom essentially kicked off, in 2007, and this production increase that you see, up until really 2019 when COVID hit the market, this dramatic increase in shale production is what destabilized the energy markets for now, more than a decade. It drove the energy's weighting in the S&P 500 from 15% in 2007 down to only 3% now.
So right here, what we're looking at, this is like 5 million barrels a day or so, maybe 5.5 from the U.S. In 2010.
Really 7. I mean, it was more like 5 in 2008.
Okay.
And then it's driving up here above 13 now.
Okay.
So to see this type of production increase coming from a single country over a short period of time, when you think that the entire world really only grows 1 to 1.5 million barrels a day, I mean,
Per year, yeah.
It's undeniable that shale has been a disruptive force for energy markets. This rampant amount of production is what has basically, gifted the world, nearly, 10, 15 years of cheap oil.
Yeah.
But when this growth comes to an end, I think that it's going to invite people back into the energy sector because they're going to realize the run is done. We're getting back to slow growth in the years ahead, and where's the oil going to come from?
Yeah. Yeah. Okay. And total annual production for the planet is like 104 million barrels per day?
Yeah, it's like 103, 104. I mean, definitely no more than 105 right now. And next year, they're looking for another 1.1 to 1.5 growth.
Okay.
So again, like you don't tend to grow more than 1, 2 at best a year.
Yeah.
So when one country is supplying that much supply, it hurts the entire energy system. And that's why for the past couple of years, which actually we're about to talk about a little bit, is how OPEC has actually constrained their production to try to stabilize the market.
Okay.
So let's look at this kind of in terms of the oil price curve. I love to talk about the history of oil prices over the last 2 decades. So prior to the financial crisis in 2009, oil hit nearly $150 a barrel. And that was because we were supply constrained. Demand was growing, but we didn't know where we were going to grow barrels from. Then the financial crash hit, and that's where you see this dramatic decline. and then markets started to stabilize. So after the crash normalized, and from 2011 to 2014, oil was range trading between 90 and 110 US dollars per barrel. In today's inflation adjusted dollars, oil would be range trading between 124 and $152 per barrel. Simply stated, $80 per barrel then is $110 per barrel now. And this is one of the reasons why I'm always saying oil is so cheap right now.
Yeah.
So what created this recency bias towards cheap oil? The increased supply created from the U.S. oil shale boom was so great in 2014 that the price of oil started to fall. Completed well costs were coming down and well production was up thanks to the first 7 years of learning and optimization in the shale play. Oversupply and low global prices was upsetting OPEC countries and just the general market dynamics being in flux. Saudi Arabia responded by growing their production to regain market share. That's what drove crude oil prices down into the 30s in 2016, a true bare-knuckle global price war. Eventually, there was enough price damage and underinvestment occurred for common ground to be found, and oil was stabilizing in the $55 to $75 per barrel range prior to COVID. But even while oil prices remained ridiculously low, U.S. shale producers continued to increase supply from 4.5 million barrels per day to more than 8 million barrels per day. The cumulative amount of secured and unsecured debt of more than 500 U.S. oil companies going bankrupt and were disclosed in their filings from January 2015 through June of 2020 was more than $300 billion. So you can thank all those business failures for the years of cheap oil. $50 per barrel in 2015, like I said, it's $65 to $70 per barrel now, pretty much exactly where oil is now. And we fell into 60s many times over the past 2 years. That price is a price that bankrupts the industry, and it's only recently that we're starting to see U.S. shale starting to plateau. That's why it's been horrible to be an oil and gas investor for the last couple of years. So I'm really going to briefly talk about OPEC.
Okay.
3 of the 5 largest oil producers in the world are OPEC countries. I'm not going to go into them in detail because for the past 4 years, they have been uniquely disciplined and aligned in their mission of providing market balance.
And that was how many barrels per day each one of them put out?
Yeah.
Okay.
In 2022. So, but when we talk about market balance, so in 2020, so you have OPEC. OPEC is in black, their production, and non-OPEC here is in red. So in 2020, OPEC, actually during the COVID crisis, they cut their production more deeply than non-OPEC nations. And they were more cautious in adding back barrels to return to their pre-COVID baseline. Since the summer of 2022, oil prices have been down to flat. This was when non-OPEC oil supply continued to grow despite lagging demand. OPEC once again further curtailed their production to balance the market, which reinvigorated this global price war narrative. But really, there has been no price war. So long as OPEC has curtailments going on and continue to defer the barrels, there is no price war. I believe that these OPEC nations eagerly want their barrels back in the market, but not at any price. With global oil inventories low, they will continue to keep the threat of additional supply hanging over the heads of marginal non-OPEC producers to check their supply growth. Then they'll add to the global supply only as needed. In other words, OPEC will gradually ease back into the market in a controlled fashion as prices dictate, or maybe as these sanctions strengthen. So it would be a huge relief to a lot of oil investors if Trump does strictly enforce the sanctions. Again, it's gonna wipe out most of OPEC's curtailed supply. So now let's talk about the non-OPEC growers, because those are the companies and countries that for the last 2 years have oversupplied the market. The combined oil production from Canada, Brazil, Guyana, and Argentina has grown by about 500,000 barrels per day year over year since 2020. Including the U.S., global production was growing at 1.2 million barrels per day year over year, and the U.S. was 60% of supply growth in recent years. And this is where this idea of $50 oil next year is coming from, because a lot of people believe that the U.S. is going to continue to grow at an extravagant pace. But if they don't grow, then 600 to 700,000 barrels that some people believe is coming is never going to show up.
Okay.
So under OPEC's current market balance approach of only adding supply as needed, we actually see that the EIA is predicting that for next year, the market's going to be very balanced. The EIA is predicting that liquid production and consumption is very tight, with a slight undersupply in the first half and ending with a slight oversupply in the fourth quarter. Any undersupply could easily be covered by storage withdrawals. So again, like where are the oversupply growth threats? Canada is the fourth largest producer of crude oil. They generate more than 5 million barrels of oil per day. As you can see, growing production is simply what they do. The U.S. imports 4.5 million barrels a day of their oil to refine. The next year, they plan to increase CapEx by 7.5% and are once again expected to grow production by 300 to 400,000 barrels. Let's see what happens under the Trump tariff threats. But I don't think that they could grow more than that. They might not even hit the 300 to 400,000 barrels per day if any of their other assets underperform, because a 7.5% increase in CapEx isn't a whole lot. Brazil's oil production has averaged about 3.4 million barrels per day, and they've been relatively flat this year. Most of their production comes from offshore, and it's easy to track. They will add about 250,000 barrels per day of supply next year. And most of their supply is coming from Petrobras. This total production chart is a Petrobras chart, and you can see how over the next 5 years, they're only slowly ramping up their supply in a very controlled fashion.
Yeah.
The biggest surprise for some might be the flattening production from the U.S. The most recent EIA STIO, which is the short-term energy outlook, is noteworthy. 2025 U.S. oil production is expected to plateau from wherever it is at the end of 2024 and stay flat all along 2025. Many believe that the weekly reports are currently overstating today's supply by a few 100,000 barrels per day, which will make for some really interesting monthly reports in the quarter ahead. So the weekly production reports that we get each week from the EIA are really just forecast. The monthly reports that roll in 3 months later are the accurate information. The two largest producers in the Permian are Exxon and Chevron, and they have recently announced that they plan to plateau or only nominally grow production from Q4 of 2024 over 2025. Now, Exxon and Chevron have the largest footprints in the Permian Basin. They have the largest economies of scale. If these guys aren't aggressively growing their barrels, you shouldn't really expect anyone else to either. And even if the other companies do, they're so small that they're not moving the needle like Exxon and Chevron.
That makes sense.
So, the Permian Basin, the U.S.'s supply engine, tongue in cheek, could be the oversupply region. Um, um, so, since 2008, unconventional oil production, also known as tight oil or shale oil, has been the only real driver of U.S. supply growth. The unprecedented ramp up in this supply ushered in the era of cheap oil and destabilized the global market, as I mentioned before. But it's, Art Berman posted this slide, which I think it's really great because, you can see the legacy older assets and how they're declining. The legacy conventional production in decline. Alaska, which a lot of people talk about, I mean, it's deeply in decline. They do have some new oil fields there that over the next couple years, might come online. But even best case scenario for Alaska, I mean, you wouldn't expect, more than a few hundred thousand more barrels to be built out, over the course of multiple years. It's not gonna come on next year. Offshore, because of deep water, is growing, but again, this is a small portion of U.S. production. I mean, we are heavily reliant on tight oil, on shale oil.
Yeah.
So the Permian Basin, which is the tight oil for the most part, supplies 48% of U.S. oil production, nearly half. 86% of the 48% are from shale, and only 14% of the oil from the Permian Basin comes from mature conventional assets.
Okay.
Outside the Permian Basin, U.S. producers have been relatively flat for 4 straight years.
Did you slide past an extra slide there? Maybe I missed it.
Oh, I had that same technical problem I had before. Or not, maybe I skipped over. Yeah. So this is where I'm basically saying that. So the Permian is nearly half of U.S. supply,
Mhm.
but the Permian is made up of both shale and conventional. But shale is 86% of the Permian supply.
Yeah, it's like conventional was 0.9 million barrels per day, and shale was whatever the difference is, 5.5 or something.
Yeah.
Okay.
0.9 being 900,000.
Okay.
5.5 being 5.5 million barrels of oil per day. So now let's dive into the Permian zoom in even further. So drilling rigs outside the Permian Basin have declined by nearly a third since 2022. Drilling rigs in the Permian are only down by 15%. Thanks to efficiency gains, Permian operators are drilling nearly as many wells today despite the reduced rig rate. But that doesn't hold true elsewhere. And that's why we see outside the Permian Basin, production is actually edging lower. DUCs are drilled but uncompleted wells. Notice the sharp decline in DUCs from 2020 to 2023 in the Permian and even outside the Permian. Activating those wells post-COVID helps support the rampant production growth, but it appears that they are currently holding at maintenance levels because those well completions have been relatively flat for 2 years. In the event of another supply shock, the Permian would not be able to scale rapidly without first activating more rigs and drilling more wells. So if there was a supply shock tomorrow, you could expect a 6 to 12-month lag before you saw, a big increase in production out of the Permian Basin, but only if you see more rigs going first, which is important. So Permian well production by all well vintages is also flattening. It appears that the productivity gains have peaked and could even be modestly declining. And that's also important. So over the last couple of years, anybody who closely follows the Permian Basin, you've been hearing about longer laterals. And in a way, lateral length can also be thought about as time because, first operators were drilling 2-mile lengths and then they started drilling, 3-mile lengths. And then now, some of them, Exxon is even drilling like 4-mile lengths. And and when you nominalize those laterals on a per footage basis, so long as they're all providing you the same amount of barrels per lateral foot, then basically you're not seeing any productivity lag, from the reservoir rock itself. But what we're actually seeing in both sides of the Permian Basin, the Delaware and the Midland, is as these wells have gotten longer, they've peaked at lower and lower rates of production. And that's, I believe that's because they're drilling poor quality rock through time. So you're not going to be able, you're having basically more challenges to overcome. And but this early time tier degradation that you're starting to see, I mean, it's really important when you think about the number of wells that will be needed in the years ahead to sustain the current amount of production out of the Permian Basin.
So basically, you're saying they're drilling these further and further laterally into the earth, but it's not like they're pulling out the same amount of oil all the way through. They're pulling out less and less.
Per foot.
Per
So
foot.
basically what they're doing now is if they used to drill a lateral length with one well that was 1.5 miles long, they had to drill 2 of those wells for what 1 3-mile well would do. But if you compared the 2 1.5-mile wells to the 1 3-mile well, today that 3-mile well is actually getting you less oil.
Yeah.
Because the reservoir that is left for them to drill this well into, it's not as good as it was 10 years ago. Like oil companies always try to drill their best acreage first.
Yeah, just like a gold miner or anyone else. You take the easiest stuff first.
Yeah, you're slowly, and in the Permian Basin, you'll hear a lot of talk about tier 1, tier 2, tier 3. You know, a lot of companies have already burned up all of their tier 1 acreage. Now they were activating tier 2 acreage with a lot of these efficiencies and trying to produce just as efficiently as the tier 1 was doing, and they have like had exceptional performance with the things that they've done, but all these different efficiency gains, like there's a limit to them, and what we're starting to see with these lower production being normalized over the footage is you're starting to see the signs of the Permian starting to get tired.
Okay.
So now let's talk about ongoing operating challenges in the Permian. I believe that there are geophysical and structural challenges growing under the radar in the Permian, challenges that will likely lead to some production decline in the years ahead. Every oil and gas well is also a water well. The Permian is no different. Permian Basin wells produce significantly more water than they do oil. Therein lies the dirty truth. The average is 4 barrels of water per each barrel of oil that comes out of the ground. But in some areas, the ratio can be as high as 12-1. These numbers put the Permian Basin's average water cut higher than any other unconventional play. And when I say water cut, I mean the amount of water that's being produced per barrel of oil. It's already producing nearly 21 million barrels of water per day. That's enough water to fill up Lake Travis and Austin every 20 months. And that number would nearly double by 2030 if oil and gas production continued to grow.
Okay, so 21 million barrels per day of water, and they're pulling out about 6 million barrels per day of oil?
Correct.
Okay.
So that volume, 21 million barrels a day, it makes water handling a unique challenge in the Permian Basin. Conventional oil wells generally consume as much water as they generate. Conventional producers can recycle their produced water by re-injecting it into the exact same formation to help maintain the reservoir's downhole pressure and enhance their long-term hydrocarbon recovery. This is called enhanced oil recovery. But unlike conventional reservoirs, shale is impermeable, and its produced water cannot be re-injected back into the shale in a sustainable manner. Unconventional shale producers must find alternative formations and uses to dispose of their produced water. Underground injection remains the most common water disposal route, but water production is growing faster than subsurface disposal capacity. Saltwater disposal wells are they're preferred because they're the lowest cost, but there's a remaining in-basin capacity to keep disposing the water. And this is shown by the seismicity and the surface deformation. Continued seismicity, earthquakes that are associated with water disposal practices have triggered severe restriction on saltwater disposal in some of the most active parts of the basin. Overpressure in subsurface disposal zones is also reducing injection capacity for new wells. They're eroding the economics of these saltwater disposal wells and are forcing third-party pricing even higher. So the water handling component of OPEX is the highest component of lease operating expense. So when these water handling prices increase, they're significantly increasing the OPEX. Future solutions are available through pipeline processing and water recycling that can be built out. But all of those alternatives are capital intensive, and those costs would be passed on to the operators, and that would hurt their break-even prices.
Okay.
So you got to think, like, for every if you're averaging 4 barrels of water for each barrel of oil, for every 25 cents that gets added to your per barrel water cost, you're adding $1 to your oil break-even cost.
Oh.
And if your water cut is one of these old wells that are making 10 barrels of water per day, then the economics are even worse because you're multiplying that quarter by 10, and it might not even be a quarter. It like on average right now, they're paying like 75 cents a barrel for water disposal. But and those are the big companies. Little guys are paying $1.50 or even $2 a barrel for their disposal. And so again, like, the economics get hurt really badly if these prices increase or if their water cuts increase.
Yeah, so let me just make sure I understand. So as the oil comes out, it comes out with 3 times or 4 times as much water. They have to do something with that water because it has a lot of bad stuff in it, right?
Yeah, it's super salty. So this water is 3 or 4 times as salty as seawater. So if you were to dump it on the ground, you'd kill the ground. Like, you wouldn't be able to grow anything there. It's got radioactive solids in it, like fine solids from underground. I mean, it might have valuable stuff in it, like lithium, but still, I mean, mining lithium is also going to be expensive. It could have chemicals in it that were used during the well stimulation process. So again, like the economics around trying to clean this water, it's very high. So if you were to try to clean the water for beneficial reuse for say agriculture, outside of oil and gas, the economics on the per barrel charge would be like $2.50 per barrel, or even $10, as high as $10 per barrel. So even on the low side of $2.50, you multiply that by 4. Okay, so now you just added $10 to your break-even cost of oil.
Yeah. Yeah. Okay.
I mean, if they can't re-inject this in the basin, prices start ratcheting high very quickly. So let's say they're going to build a long haul pipeline and start re-injecting it somewhere else. I mean, maybe that increases their cost from 75 cents to $1 or $1.25. But still, when you start multiplying it by the amount of oil and everything else, I mean, it's significantly changing their break-even price. And there's also going to be the time delays associated, with building out additional infrastructure that's going to be needed for water management in the Permian Basin in the years ahead.
We are going to break this into 3 parts. When we come back, we will continue the discussion on the Permian Basin. Make sure you subscribe and hit the bell notification icon so you know when parts 2 and 3 come out. And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.